Alex. Alex has $10,000 sitting safely in a savings account earning 3% interest. At the same time, he carries $10,000 of credit card debt, charging 21%. Every morning, Alex checks his account and feels reassured. There is money in the bank. He feels financially responsible. But mathematics tells a different story. While his savings quietly earn about $300 per year, the credit card company collects more than $2,000 in interest. The gap between those numbers is not small. It is devastating. Alex believes he is building financial security. In reality, his balance sheet is eroding every single day. This is the illusion of wealth. Many people approach personal finance with two separate conversations. One conversation is about investing, the other is about debt. But in truth, they are expressions of the same underlying force. Leverage on your future. Every dollar borrowed pulls tomorrow's income into today. Every dollar invested sends today's money forward into tomorrow. Debt and investing are not opposing concepts. They are simply two directions on the same timeline. The real question is not whether you should do one or the other. The real question is which direction your financial leverage is pointing. Finance often appears complicated because it is surrounded by jargon. Yet the underlying mathematics is surprisingly simple. Debt is negative leverage. Investing is positive leverage. Negative leverage guarantees a loss. Positive leverage offers the possibility of gain. Imagine carrying a credit card balance with a 20% interest rate. That interest charge behaves like gravity. Every year, the debt pulls 20% more weight onto your balance. Meanwhile, the stock market historically produces long-term returns around 7 to 10% annually. Notice the asymmetry. A 20% debt obligation is not competing with an 8% investment return. It is overwhelming it. This leads to what many financial planners call the interest rate boundary. When debt carries an interest rate significantly above the expected long-term return of the market, eliminating that debt becomes mathematically superior to investing. Standard financial planning rule that debts above 6 to 8% should typically be prioritized over investing. Paying down a credit card, charging 18% produces a guaranteed 18% return. No investment portfolio can promise that outcome. Markets fluctuate. Interest charges do not. But the story becomes more nuanced when interest rates fall. Consider a mortgage at 3%. Now the dynamic changes. If a diversified portfolio historically compounds closer to 8% over long periods, capital placed into markets may grow faster than money used to eliminate that low-cost debt. This is the difference between destructive leverage and productive leverage. One drains wealth, the other can accelerate it. Mathematics establishes the boundary. But mathematics alone does not explain why people struggle with this decision. For that, we must examine behavior. Money problems rarely originate from arithmetic. They originate from philosophy. Success is not something you pursue. Success is something you attract by the person you become. The same principle governs wealth. A person's financial outcomes reflect their habits long before they reflect their investments. Behavioral finance researchers have documented something called the behavioral gap. The behavioral gap measures the difference between the returns markets generate and the returns investors actually experience. Surprisingly, many investors underperform the very funds they own. Not because the investments fail, but because emotions intervene. They buy during excitement. They sell during fear. Debt introduces another psychological dimension. Uncontrolled debt often signals a deeper pattern of consumption, impulse spending, short-term thinking, a tolerance for financial disorder. Attempting to build an investment portfolio while these habits remain unresolved is like constructing a skyscraper on unstable soil. You cannot build a monument on quicksand. The problem is not the market. The problem is the underlying behavior. People often hope that investing will rescue them from poor financial discipline. But investing is not an escape hatch. It is an amplifier. If the foundation is unstable, leverage magnifies the instability. Before capital can compound successfully, character must compound first. Discipline precedes prosperity. The solution is not ideological, it is strategic. Personal finance works best when debt management and investing operate as a coordinated system. Consider two different financial stories. Sarah carries $20,000 of credit card debt with interest rates above 18%. At the same time, she experiments with speculative investments, hoping for rapid profits. Some months she wins, other months she loses. Meanwhile, interest compounds relentlessly against her balance. One market downturn erases her trading gains while the debt continues to grow. This is not investing. It is gambling on a house of cards. Now consider Mark. Mark also carries debt. But his debt is structured differently. He holds a mortgage at 3% interest while maintaining $50,000 invested in diversified exchange-traded funds. His capital is positioned in productive assets with long-term growth potential. The debt remains inexpensive. The investments compound over time. Mark is not ignoring leverage. He is directing it intelligently. The contrast between Sarah and Mark reveals an important principle. Debt itself is not the enemy. Uncontrolled leverage is. When consumer debt carries high interest rates, eliminating that debt becomes the most powerful investment available. It is a guaranteed return. No volatility, no speculation, just mathematical certainty. Once high interest obligations disappear, the financial landscape changes. Capital becomes free to pursue long-term growth rather than constant damage control. That is when investing truly begins. The conversation about money often revolves around tactics. Which stock to buy? Which fund to choose? Which strategy promises the highest return? But tactics without philosophy rarely produce lasting results. Wealth is not built by chasing opportunities. It is built by managing responsibilities. Debt represents tomorrow's labor spent in advance. Investing represents today's discipline rewarded later. Both forces shape the future. But only one moves in the direction of freedom. The market does not reward excitement. It rewards patience. It rewards clarity. And most of all, it rewards stewardship. When a person learns to command their consumption, control their obligations, and direct their capital with intention, the mechanics of compounding finally begin to work in their favor. At that moment, the conversation changes. Debt stops dictating the future, and investment begins writing it. The philosophy is simple. Order your financial life so the leverage works for you, not against you. Because in the end, the most powerful asset you will ever control is not a stock, a bond, or a piece of real estate. It is your ability to govern your own behavior. And that discipline, compounded over decades, is where real wealth begins. Thanks for watching.